Okay, good afternoon, everyone. We're from Group 1 are going to explain about worldwide accounting diversity. Before we start, Prasetyo Akbar, will be introducing my group mate, which is Syams Putra Sugevi in International Accounting Class B by Dr. Ratna Septiyanti, M.Si. Today, we will discovering about what is accounting diversity. There are few learning objectives about this main topic, which we are going to explain one by one. The first one is about the evidence of the diversity of accounting. The second one is what kind of problems caused by this diversity. And the third one is what if major, is not what if, is what major environmental factors that affect the diversity. The fourth one is judgmental classification, and the next one is cultural influences. Why is cultural influences affect the diversity of accounting standards? And the second to last is simplified model of the reason. We are going to see how simplified model of the reasons. And the last one is about categorizing the accounting differences. In the judgmental classification, I'm going to make more explanation because there are some kind of table that I'm going to discuss with you guys. And then before we enter the evidence of diversity of accounting, I'm going to explain about what is accounting diversity. Considerable differences exist across countries in the accounting treatment of many items. For example, companies in the United States are not allowed to report property, plant, and equipment at amount greater than historical cost. In contrast, companies in the European Union are allowed to report their assets on balance sheets at market values. Research and development costs must be expensed as incurred in Japan, but development costs might be capitalized as an asset in Canada and France. So, the differences in accounting can result in significantly different amount being reported on the balance sheet and income statement. Okay, now we are going to enter the evidence of accounting diversity. In this particular slide, we will see the differences between this exhibit in which we shown exhibit 2.1, 2.2, and 2.3, in which exhibit 2.1 represents the British company for the Phone Group PLC, and the exhibits 2.2 is going to be presented by US competitors Verizon Communication. The statement shows several differences in format and terminology between the United Kingdom and the United States. Perhaps the most obvious difference is the order in which assets are presented, whereas Verizon presents assets in order of liquidity, beginning with cash and cash equivalents. Vodafone presents assets in reverse order of liquidity, starting with goodwill. On the other side of the balance sheet, Vodafone presents its equity account before liabilities. We can see it right here on the slide. In the equity section, call up share capital, this one, is the equivalent of the common stock account on the US balance sheet. And and share premium account is the contributed capital excess of per value. Vodafone uses a capital redemption reserve, this one, to indicate an appropriation of return earning. Reserves are unknown in the United States. Vodafone includes provisions which represented estimated liabilities related to restructuring, legal disputes, and asset retirement in both current and non-current liabilities. These kind of line items does not appear in the US balance sheet. We can see they are known. Common for US companies, Verizon includes only consolidated financial statement in its annual report. In addition to consolidated financial statement, Vodafone also includes the parent company's separate balance sheets in its annual report. I'm sorry. This is shown in Exhibit 2.3 in the parent company balance sheets. Investment in subsidiaries are not consolidated, but instead are reported as shares in groups undertaking this one. In the fixed asset section, liabilities are called creditors, and the receivable are debtors. This one. From the perspective of US financial reporting, the UK parent company balance sheet has an unusual structure. Unusual. Rather than the US norm of assets equals liabilities plus shareholders' equity, for the foreign parent company balance sheet is presented as assets minus liabilities equals shareholder equity. There's some small differences, and closer inspection shows that the balance sheet presents the left-hand side of the equation as non-current assets plus working capital minus non-current liabilities equals shareholder equity. Okay, now we are going to enter reasons for accounting diversity. Before we enter the the sub-chapter, I'm going to expand a bit about the question. Why do financial reporting practices differ across countries? So accounting scholars have hypothesized numerous influences on a country's accounting system, including factors as varied as the nature of the political system, the stage of economic development, and the state of accounting education and research. A survey of the relevant literature has identified the following 5 items as being commonly accepted as factors influences a country's financial reporting practices. This is the common influences that affect the accounting diversity. The first one is legal system. There are two legal systems used around the world. The first one is common law, and the second one is codified Roman law, or the code law for short. The common law began in England is primarily found in the English-speaking countries of the world. Common law countries rely on a limited amount of statute law, which is then interpreted by the courts. Court decision establish precedents, thereby developing case law that supplements the statutes. Meanwhile, a system of code law, followed in most known English-speaking countries, originated in the Roman Jus Civil and was developed further in European universities during the Middle Ages. Code law countries tend to have relatively more statute or codified law governing a wider range of human activity. Now, the big question is, what does a country's legal systems have to do with accounting? First of all, code law countries generally have corporation law, sometimes even called a commercial code or Companies Act, which establishes the basic legal parameters governing business enterprises. The corporation law often stipulates which financial statement must be published in accordance with a prescribed format. Additional accounting measurement and disclosure rules are included in the accounting law, debated and passed by the national legislature. Meanwhile, in code law countries, the accounting law tends to be rather general and does not provide much detail regarding specific accounting practices and may provide no guidance at all in certain areas. A good example of these code law countries is Germany. Germany is a good example of this type of code law country because the Germany accounting law passed in 1985 is only 47 pages long and is silent with regards to issues such as leases, foreign currency translation, and cash flow statement. When no guidance is provided in the law, German companies revert to other sources, including tax law, opinions of the German auditing profession, and standard issues by the German Accounting Standards Committee to decide how to do with their accounting. In common law countries where there is likely to be a non-legislative organization developing accounting standards, much more detailed rules are developed. The extreme case might be the Financial Accounting Standard Base or FASB in the United States, which provides a substantial amount of implementation guidance in its Accounting Standards Codification or AAC, and updates has been accused of producing a standard overload because of how many standards that they put out. Okay, the second one is taxation. In some countries, published financial statement form the basis of for taxation, whereas in other countries, financial statements are adjusted for tax purposes and submitted to the government separately from the report sent to stockholders. We're going to continuing to focus on Germany. The so-called congruency principle in that country stipulates that the published financial statements serve as the basis for taxable income. In most cases, for an expense to be deductible from tax purposes, it must also be used in the calculation of financial statement income. Well-managed German companies attempt to minimize income for tax purposes. Meanwhile, in the United States, in contrast, conformity between the tax statement and financial statement is required only with regard to the use of the last in, first out, atau LIFO sebutannya, inventory cost flow assumption. US companies are allowed to use accelerated depreciation for tax purposes and straight line depreciation in the financial statement. The difference between tax and accounting income give rise to the necessity to account for different income taxes, which is becoming a major issue in the United States in recent years. The third one is providers of financing. The major provider of financing for business enterprises are family members, banks, government, and shareholders. In those countries which uses this some kind of system, in which company financing is dominated by families, banks, or the states, there will be less pressure for public accountability and information disclosure. As companies becomes more dependent on financing from the general populace through the public offering of shares of stock, the demand for more information made available outside the company becomes greater. It's simply not feasible for the company to allow the 100,000 or hundred of thousands of shareholders access to internal accounting records. The information needs of those financial statement users can be satisfied only through extensive disclosure in accounting reports. The second to last is inflation. We all know what inflation is. Countries experiencing chronic high rates of inflation found it necessary to adopt accounting rules that require the inflation adjustment of historical cost amounts. This was especially true in Latin America, which is a region has had more inflation than any other part of the world. For example, throughout the 1980s and the 1990s, the average annual rate of inflation rate in Mexico was approximately 50% with a high of 159% in 1987. Adjusting accounting record for inflation result in a write-up of asset and therefore related expenses. Adjusting income for inflation is especially important in those countries in which accounting statements serve as the basis for taxation. Otherwise, companies will be paying taxes on fictitious profits. The last one is political and economic ties. Accounting is a technology that can be relatively easily borrowed from or imposed on another country. Through political and economic links, accounting rules have been conveyed from one country to another. For example, through previous colonialism, both England and France have transferred their accounting framework to a variety of countries around the world. For example, again, British-style accounting system can be found in countries as far-flung as Australia and Zimbabwe, and French accounting is prevalent in the former French colony of Western Africa. More recently, it is the talk of economic ties with the United States have had an impact on accounting in Canada, Mexico, and Israel. Aside from these five common influences, there is one more kind of like influences to the diversity of accounting, which is whether by coincidence or not, there is a high degree of correlation between legal system, tax conformity, and a source of financing. Usually, common law countries tend to have a greater number of domestic listed companies, relying more heavily on equity as a source of capital, and code law countries tend to link taxation to accounting statement and rely less on financing provided by shareholders. Okay, now we are going to examine what problems caused by accounting diversity. The first one is the preparation of consolidated financial statement, and which explained in this slide. The diversity in accounting practices across countries causes problems that can be quite serious from some parties. Each foreign operation must either maintain two sets of books prepared in accordance in both local and, for example, the US GAAP. For example, consider General Motors Corporation, which has subsidiaries in more than 50 countries around the world. And each subsidiary incorporated in the country in which it is located is required to prepare financial statement in the country in which it is located to require to prepare financial statement in accordance with local regulation. For example, again, in General Motors de Mexico, prepare financial statement in Mexican pesos using Mexican accounting rules, and General Motors Japan prepare financial statement in Japanese yen using Japanese standards. The second problem that can arise from this diversity is access to foreign market. Just like in the slide, a second problem caused by accounting diversity relates to companies gaining access to foreign capital markets. If a company desires to obtain capital by selling stock or borrowing money in a foreign country, it might be required to present a set of financial statements prepared in accordance with the accounting standards in the country in which the capital is being obtained. For an example, consider the case of the semiconductor manufacturer STM Microelectronic, which is based in Geneva, Switzerland. The equity market in Switzerland is so small and the ST's capital needs are so great that the company has found it necessary to have its common shares listed on the Euronext Paris and Borsa Italiana stock exchanges in Europe and on the New York Stock Exchange in the United States. To have stocks traded in the United States, foreign companies must either prepare financial statements using US accounting standards or provide a reconciliation of local GAAP net income and stockholders equity to US GAAP. This in fact can be quite costly. The third problem is comparability of financial statement. This can significantly affect the analysis of foreign financial statement for making investment and lending decision. A lack of comparability of financial statement also can have an adverse effect on corporation when making foreign acquisition decision. The fourth one, or the last one, is a lack of high quality accounting information. A fourth problem associated with the accounting diversity is the lack of high quality accounting standards in some parts of the world. International investor and creditors were unable to adequately assess risk because financial statements did not reflect the extent of risk exposure. This is due to the following disclosure deficiency. The first one is because the actual magnitude of debt was hidden by undisclosed related party transactions and off-balance sheet financing. The second one is high level of exposure to foreign exchange risks were not evident. The third one is information on the extent to which investment and loans were made in highly speculative assets was not available. The fourth one is contingent liabilities for guaranteeing loans, often foreign country loans, were not reported. The fifth one, appropriate disclosure regarding loan loss provision were not made. To be sure, inadequate disclosure did not create the East Asian meltdown. This is like a general agreement because of the same problem in East Asian financial crisis. And then we are going to enter major environmental factors in the diversity of accounting. In this subchapter, we are going to see about accounting clusters. Given the discussion regarding factors influencing accounting practice worldwide, it should not be surprising to learn that there are clusters of countries that shares common accounting orientation and practices. And in the right side of the slide, we are seeing the NOBS kind of like classification of the cluster of accounting. There are three models of accounting. The first one is the fair presentation full disclosure model, or Anglo-Saxon or Anglo-American model. These models usually oriented towards the decision needs to large number of investors and creditors and mainly used in English-speaking countries influenced by the United Kingdom or the United States. This one. And the second one is the legal compliance model, or the continental European model, which is legalistic, used to provide information for taxation and government planning, and usually used in Europe, Japan, and court law countries. This one. And the last one is the inflation adjusted models. It resembles a bit the continental European model, the before one, and it requires extensive use of adjustment for inflations. Now we are going to enter the judgmental classification. Now, there are three classifications based on this. The first one is developed by NOPS. NOPS developed a more refined classification scheme that attempts to show how the financial reporting system in 14 developed countries relate to one another. based on the system before, the table before. But we are going to focus on the micro-based Anglo-Saxons and the macro-uniform continental European. Based on the slides, micro-based class of accounting system, there is a subclass heavily influenced by business economics and accounting theory. The country which is the first subclass influenced by is Netherlands, and the second subclass influenced by this business practice and pragmatic practices is the United Kingdom and United States dominated. And the macro uniform continental European, the first subclass align with a national economic policies, example, Sweden, like on the slide, on the macro uniform side of the classification, a government economic subclass has only one country, Sweden. Meanwhile, the second subclass, continental government tax legal, the user of this macro uniform is Germany and Japan and many Southern European countries. I think that's it from me. Thank you for listening, and I am going to give the moment to my groupmate for Adam. Adam, the stage is yours.
Thank you, Prasetyo. Here I will explain about the influence of culture on financial reporting. There are three factors that influence culture on financial reporting. First is hosted culture dimension. Hosted culture dimension are a concept developed by Gert Hofstede, a social psychologist and anthropologist from the Netherlands. Hofstede conducts cross-cultural research in the 1960s and 1970s at IBM with the aim of understanding cultural difference in the context of international business. There are several ways to describe general, similar, and different in word culture. Number 1, individuals. Number 2, power distance. Number 3, uncertain avoidance. Number 4, masculinity. Number 5, long-term orientation. And the next, Gray's accounting value. Gray's model postulate and direction in the relationship between the accounting values and hosted culture value. Grace describe the accounting value as follows. Number one is professionals versus stationary control. Number 2, uniformity versus flexibility. Number 3, conservative versus optimist. Number 4, secrecy and transparency. And then the third is religion and accounting. Religion plays an important role in defining national culture in many parts of the world and can have a significant effect on business practice. Under Islam, for example, the Quran provides guidance with respect to issues as the making charitable contribution and charging interest and loans. In some Islamic countries, banking companies operate under Sharia, the Islamic law of human conduct derived from the Quran. The framework for the development of accounting system we can see in this slide. Okay, next, a simplified model to explain financial reporting international difference. NOPS divides financial reporting system into two classes labeled A and B. Class A is accounting system are found in country with strong equity outside shareholder financial. In Class A, accounting system measuring practice are less conservative. Disclosure is extensive, and accounting practice differs from tax rules. Class B, accounting systems are found in countries with weak equity outside shareholder financial system. Measuring is more conservative. Disclosure is not as extensive, and accounting practice more closely follow tax rules. Class B responds to be consistent Europe accounting. Next, further evidence of accounting diversity. These differences are taken into consideration of USA financial conditional in general reference as a reference point. Number one is financial statement. Number two, format of financial statement. And then number three, level of detail. Number four is terminology and disclosure. Next slide, we can see this is an example of financial reporting in the USA. Okay, that's enough from our presentation in chapter 2 regarding worldwide accounting diversity. Thank you.
Okay, I guess that's it from Adam and me. Thank you for listening. And if you guys have any question regarding our presentation about worldwide accounting differences, you guys can ask us by raising your hand in the Zoom class. Thank you.